At first, the idea feels like a contradiction. Nearly every nation on the planet carries some level of public debt, yet the global financial system keeps moving forward as if this is completely normal. That raises the fascinating question at the heart of this story. If almost every country owes money, who is actually on the other side of the ledger? The answer begins with one simple truth. A country's debt is usually not owed to one mysterious owner, but to a vast network of holders spread across its own economy and the wider world. Governments borrow by issuing bonds, which are essentially promises to repay money with interest over time. Those bonds are then purchased by pension funds, banks, insurance companies, investment firms, public institutions, central banks, and even ordinary people through savings products and retirement accounts. In other words, a huge portion of national debt is often owned by the same society that appears to owe it. IMF +1. This is where the story becomes deeper and more surprising. The global debt system is less like one person borrowing from another and more like an enormous circular web of promises, assets, and future expectations. One country may owe money to domestic investors, while those investors also own foreign bonds from other nations. At the same time, overseas institutions may hold debt from multiple countries as part of reserve management or long-term portfolio strategy. A retirement fund in one region can indirectly finance infrastructure in another. A central bank can hold government bonds as part of monetary stability operations. A commercial bank may store part of its safest assets in sovereign debt. Because of this, the creditor is not a single nation, secret group, or isolated power. It is a layered financial ecosystem where one side's liability becomes another side's prized asset. Corporate Finance Institute +1. To understand the paradox, imagine the world economy as a giant living machine powered by trust. Governments need funds to build roads, support education, strengthen institutions, respond to emergencies, and invest in future growth. Instead of collecting all that money instantly through taxes, they spread the cost over time by borrowing. The lenders, meanwhile, are not simply giving money away. They are buying one of the most trusted financial assets available, government-backed bonds. These assets help support savings systems, retirement structures, institutional reserves, and economic confidence. So when it seems like everyone is in debt, what is really happening is that the same global system is constantly transforming savings into loans, loans into assets, and assets back into future spending power. Debt, in this sense, is not merely a burden. It is one of the core engines that keeps modern economies functioning. IMF +1. The real mystery, then, is not whether there is a creditor, but how the same world can be both borrower and lender at the same time. That is the tension that drives the rest of this story forward. Behind every government obligation lies someone's investment, someone's retirement security, someone's institutional reserve, or someone's long-term confidence in the future. The first key revelation is this. Countries are often indebted not to a distant other, but to their own citizens, their own financial systems, and a globally interconnected network that turns promises into economic fuel. Once this foundation is clear, the next part of the story can explore the hidden architecture of how money, bonds, and central institutions transform debt into the backbone of the modern world itself. To understand why nearly every country operates with debt, and why that doesn't immediately break the system. You have to step back and look at how modern money itself evolved. What most people think of as money is no longer just physical currency moving from hand to hand. Instead, it is deeply connected to credit, trust, and future expectations. Over time, economies shifted from simple trade and hard currency systems into complex financial structures where borrowing and lending became essential tools for growth. Governments discovered that by issuing bonds, they could access large amounts of capital quickly without disrupting everyday economic life through sudden tax increases. At the same time, investors realized that government debt could serve as a stable and relatively predictable place to store wealth. This mutual benefit gradually transformed debt from something temporary into something foundational, an ongoing mechanism that supports the entire financial system rather than a problem to be eliminated. The turning point in this transformation came when financial systems began to link money creation with lending. Instead of money being strictly limited by physical reserves, modern systems allowed financial institutions to expand economic activity through carefully regulated credit. When governments borrow, they are not simply taking existing money. They are often activating idle savings, channeling them into productive use across the economy. A bond purchased by a pension fund, for example, represents money that might otherwise sit unused. By investing in government debt, that capital is put to work, supporting public services, infrastructure, and long-term development. At the same time, the bond itself becomes a financial asset that can be traded, valued, and used as a foundation for other financial activities. This dual nature, being both a liability for the government and an asset for the investor, is what allows debt to scale across entire economies without collapsing under its own weight. Another important layer in this system is the role of national financial authorities, which help maintain stability and confidence. These institutions influence interest rates, manage liquidity, and sometimes purchase government bonds to ensure that markets continue to function smoothly. Their involvement reinforces the idea that government debt is not just another financial instrument. It is often considered one of the safest and most reliable forms of value within a country's financial system. Because of this, government bonds are widely used as benchmarks, collateral, and reserve assets. Banks rely on them to manage risk, investment funds depend on them for stability, and long-term savings systems use them to balance growth with security. This widespread reliance means that debt is no longer isolated. It is woven into nearly every layer of the financial structure. What makes this entire structure work is not just mathematics or policy, but belief, shared confidence that these promises will be honored over time. The system depends on the expectation that governments will continue to function, economies will continue to produce value, and financial institutions will continue to operate within stable frameworks. This trust allows debt to be rolled over, refinanced, and managed across decades, rather than requiring immediate repayment all at once. In that sense, modern debt is less like a deadline and more like an ongoing agreement between the present and the future. It is a way of saying that today's investments will be supported by tomorrow's productivity. By the end of this stage in the story, one crucial idea becomes clear: debt is not an accident of the modern world. It is one of its core design features. It connects savers to borrowers, present needs to future outcomes, and local economies to a global financial web. Understanding this shift, from debt as a temporary burden to debt as a structural foundation, sets the stage for the next part, where the story dives deeper into the hidden players behind this system and reveals how different types of creditors quietly shape the direction of entire economies. Now the story moves into the most important layer of all, the real identities of the creditors. When people first hear that nearly every country is in debt, many imagine a single invisible power sitting above the world economy, collecting payments from nations one by one. But the reality is far more complex, more fascinating, and far more interconnected. The creditors are not one person, one institution, or even one country. Instead, they are divided into powerful groups that quietly shape how modern economies survive, expand, and remain stable. Research on sovereign debt ownership consistently shows that government debt is typically spread across domestic banks, pension funds, insurance companies, central banks, households, foreign investors, and official institutions. In many economies, private non-bank investors, such as funds and insurers, have become some of the most important holders of government bonds. MBR plus 2. The first major class of creditors is domestic society itself, and this is where the paradox becomes almost poetic. A nation often owes a significant share of its debt to institutions that exist inside its own borders. Retirement funds buy government bonds to preserve long-term value for future retirees. Banks hold sovereign bonds as stable balance sheet assets. Insurance firms use them to match future obligations. Even ordinary households can indirectly become creditors through savings plans, mutual funds, and retirement accounts. This means that when a government pays interest on its debt, a large portion of that payment may flow right back into the country's own financial bloodstream. The nation is not simply paying someone else. In many cases, it is reinforcing the savings systems that protect its own people's future wealth. This circular flow is one reason sovereign debt can continue for decades without behaving like ordinary personal debt. The second major group of creditors is foreign investors, and this is where the global system reveals its deepest level of interdependence. Countries with trade surpluses, strong reserve positions, or major investment sectors often purchase the bonds of other nations as part of reserve diversification and capital management. Large international funds, reserve managers, and global institutions spread their holdings across multiple countries, balancing risk and stability. This creates a remarkable structure in which one nation's debt becomes another nation's safe asset. A country may appear heavily indebted on paper, yet its bonds are simultaneously considered highly desirable by overseas investors seeking reliability, liquidity, and long-term confidence. In recent global debt reports, foreign investors are often among the largest holders of sovereign bonds across major markets. OECD +1. The third and perhaps most misunderstood creditor group is official institutions and monetary authorities. These entities do not operate like ordinary investors chasing short-term returns. Instead, they often hold sovereign debt to support monetary stability, reserve management, or financial system resilience. Domestic monetary authorities may purchase government bonds to maintain liquidity conditions, guide borrowing costs, or stabilize markets during periods of uncertainty. International financial institutions may also become creditors through structured lending programs designed to support stability and development. Their role changes the meaning of creditor entirely because their objective is often systemic balance rather than simple profit. In this sense, some creditors exist not merely to earn returns, but to preserve confidence in the architecture of the economic system itself. What makes this part of the story so powerful is the realization that the world's debt is held by the same mechanisms that keep the world financially alive. Savings systems, reserve frameworks, institutional portfolios, and cross-border capital flows all converge into one giant ownership web. The debt of nations is not sitting in isolation. It is embedded inside retirement security, bank stability, public reserves, and long-term investment structures. That is why the question, who is the creditor, does not lead to one final name. Instead, it opens into a network where citizens, institutions, and nations themselves all become part of the answer. By the end of this chapter, the mystery transforms into a deeper truth. The creditor is the system itself, expressed through millions of holders across domestic and international layers. This sets up the next part perfectly, where the story expands further into how countries can simultaneously owe each other money in a loop that seems endless, yet remains one of the strongest pillars of modern finance. Now the story enters its most fascinating phase, the global debt loop, the reason the world can appear to owe itself money without the system falling apart. At first glance, it seems impossible. If one country holds another country's bonds, and that second country also owns assets tied to the first, why doesn't everything simply cancel out? The answer lies in the fact that sovereign debt is not a single direct handshake between governments. Instead, it exists as millions of separate promises, each with its own maturity date, interest structure, investor type, legal framework, and economic purpose. Most of the time, countries are not directly owing each other in a simple one-to-one way at all. Rather, governments issue bonds that are purchased by domestic savers, global funds, reserve managers, and foreign institutions. Some of those foreign institutions may belong to other countries, while many are private investors operating across borders. This creates a loop where capital constantly circulates internationally, yet every obligation remains tied to a specific contract that cannot simply be erased by matching it against another country's holdings. Legal clarity +1. To truly understand this loop, imagine the world economy as a vast circular river of savings and investment. A country with strong exports may accumulate large foreign reserves and choose to place part of those reserves into another nation's government bonds. That second nation uses the borrowed funds to support growth, infrastructure, public systems, and financial stability. The money spent through that activity may then stimulate trade, increase imports, or create investment opportunities that benefit the original creditor country again. In this way, money does not move in a straight line from lender to borrower. It travels in circles, constantly returning in new forms. One nation's debt security becomes another nation's reserve asset, and that reserve asset helps support currency confidence, international trade, and long-term capital allocation. The loop continues because each side is using the same instrument for different strategic reasons, not because they are trying to settle balances with one another. What makes this structure feel endless is the role of rollover financing, one of the least understood but most important features of sovereign debt markets. Governments usually do not wait until every bond must be fully repaid out of current cash reserves. Instead, when older bonds mature, new bonds are often issued to replace them. This is not inherently a sign of weakness. It is how modern sovereign finance is designed to function. As long as investors maintain confidence and the economy remains productive, old obligations transition smoothly into new ones. Because bonds mature at different times, some in months, others in years or decades, the system behaves like a moving conveyor belt rather than a fixed bill that suddenly comes due. This rolling cycle is one reason debt can appear permanent even while individual bonds are constantly being paid off and replaced. OECD debt market analysis shows that refinancing and maturity structures are central to how governments manage long-term borrowing sustainability. OECD +1. Another reason the debt loop never simply cancels out is that the assets on one side and liabilities on the other side often serve completely different economic functions. A government bond held by a foreign reserve manager may be there to stabilize exchange rate operations. The same bond, from the issuing government's perspective, financed domestic spending years earlier. Even if both countries hold each other's securities, the timing, currency denomination, yield, and strategic use are different. One may mature in 2 years, another in 30. One may support reserve diversification, another retirement savings. Because each instrument carries its own legal and financial identity, the system cannot be reduced to a simple subtraction problem. It is more like a global network of layered obligations, where every promise supports a different corner of the financial architecture. The deeper truth revealed in this chapter is extraordinary. The world's debt survives because it behaves less like a pile of unpaid bills and more like a self-renewing circulation system for capital. Countries can simultaneously borrow, lend, invest, refinance, and hold each other's assets without contradiction because the system is built on flows, not static balances. What appears from the outside as an endless loop is, from the inside, the very mechanism that keeps liquidity, trade, reserves, and public finance moving forward. Now the story reaches the most dramatic turning point yet. The entire global debt system runs on confidence, and the moment confidence weakens, the cost of borrowing can change almost instantly. Up to this point, the world's financial loop has seemed almost self-sustaining. Countries issue debt, investors buy it. Old bonds mature, new bonds replace them, and the cycle continues. But this smooth motion depends on one invisible force more powerful than any currency itself: belief that future payments will remain safe, stable, and worth holding. The moment investors begin to question that belief, even slightly, the entire rhythm of the system changes. Borrowing costs rise, refinancing becomes more expensive, and the same debt loop that once felt effortless can begin to tighten around public finances. Recent sovereign debt market analysis shows that higher borrowing costs sharply increase refinancing risk, especially when large portions of existing debt mature within short windows. OECD +1. This is where the psychology of markets becomes just as important as the mathematics of debt. Investors are constantly asking one silent question: will this country remain capable of honoring its obligations without destabilizing its economy? If the answer remains yes, demand for bonds stays strong and the debt loop keeps turning. But if doubts emerge, whether from slowing growth, rising inflation, weaker institutions, policy uncertainty, or global shocks, investors may begin demanding higher yields as compensation for added risk. Those higher yields increase the government's future interest costs, which can then deepen concerns even further. What starts as a small shift in sentiment can become a reinforcing cycle in which confidence affects borrowing costs, and borrowing costs then influence confidence again. This feedback effect is one of the most powerful forces in sovereign finance because it turns perception into real fiscal consequences. The danger becomes even greater when a country faces large rollover walls, meaning significant amounts of debt are scheduled to mature in the near future. In those moments, The country must return to markets and replace old bonds with new ones. If confidence is strong, this happens routinely. But if market sentiment has weakened, the refinancing can occur at much higher rates, dramatically increasing the cost of carrying debt forward. OECD debt data highlights that large shares of sovereign debt maturing over the next few years can expose countries to severe refinancing pressure when yields are elevated. This is why maturity structure matters so much. Debt is not only about how much is owed, but also when it must be renewed. OECD +1. Another layer of tension appears through the relationship between governments and domestic financial institutions. When local banks hold large amounts of national bonds, the system becomes deeply interconnected. If sovereign bond values fall because confidence weakens, bank balance sheets can also come under pressure. That financial stress can then circle back into the broader economy, slowing lending, weakening investment, and putting further strain on public finances. Economists often describe this as a sovereign financial feedback loop, where stress in one part of the system can magnify pressure in the other. This is one of the reasons confidence is treated almost like a national asset. It supports not just borrowing, but financial stability itself. OECD +1. What makes this chapter so powerful is the realization that the debt loop survives not because repayment is simple, but because trust keeps refinancing friction low. The moment that trust becomes uncertain, the same elegant cycle of borrowing and lending can become more expensive, more fragile, and more selective. Yet even this does not automatically break the system. In many cases, countries adapt by extending maturities, adjusting issuance strategies, improving fiscal credibility, and rebuilding investor confidence over time. Sovereign debt markets are designed to absorb uncertainty, but only as long as belief in long-term stability remains stronger than fear. Now the story reaches one of its most revealing and intellectually powerful chapters. Debt size alone does not decide whether a country is safe or under pressure. Two nations can appear to carry similar debt levels on the surface, yet one may borrow comfortably for decades while the other faces rising stress almost immediately. This is because sovereign debt strength is not measured by one headline number. It is determined by a combination of growth, credibility, borrowing costs, currency strength, investor confidence, and how the debt is structured over time. Modern debt research consistently shows that sustainability depends less on the raw debt stock and more on whether economic growth can keep pace with the cost of servicing that debt. IMF +1. The first and most important force is the relationship between growth and interest costs. If a country's economy expands faster than the effective cost of its debt, the burden becomes easier to manage even when the total number looks very large. Economic growth increases incomes, expands the tax base, strengthens employment, and improves the government's ability to service obligations without disruptive adjustments. In this environment, debt can remain stable or even become less significant relative to the economy, despite ongoing borrowing. But if borrowing costs rise above the country's long-term growth rate, the opposite happens. Interest payments begin consuming a larger share of public resources, refinancing becomes heavier, and fiscal space narrows. This is why two countries with the same debt ratio can experience completely different realities. One is growing into its obligations, while the other is being squeezed by them. IMF +1. The second critical factor is credibility, which is one of the most powerful invisible assets a nation can possess. Countries with stable institutions, consistent policy frameworks, reliable taxation systems, transparent debt management, and deep financial markets are usually trusted by investors even when debt levels are high. That trust lowers yields, extends maturities, and makes refinancing smoother. OECD debt analysis in 2026 emphasizes that strong and credible policy frameworks remain central to preserving investor confidence as markets become more dependent on price-sensitive buyers. In simple terms, credibility changes the price of risk. A trusted country may pay modest borrowing costs despite a large debt load, while a country with weaker credibility may face much higher yields at far lower debt levels. OECD. The third reason some countries handle debt better is the currency in which they borrow. Nations that issue most of their debt in their own currency generally have more flexibility because revenues, institutions, and financial systems operate in the same monetary unit. This alignment reduces exchange rate risk and gives debt managers greater stability. By contrast, countries that rely heavily on foreign currency borrowing face a much sharper edge. If their currency weakens, the local cost of repaying that external debt rises immediately, even if the original amount borrowed never changed. That single shift can turn a manageable debt profile into a rapidly intensifying burden. This is why external debt composition matters just as much as total size. Another major difference lies in who owns the debt and how long it lasts. A country financed largely by long-term domestic investors, such as retirement systems, banks, insurers, and local institutions, often enjoys greater resilience than one dependent on short-term foreign flows. Recent IMF and OECD work highlights that more price-sensitive investors now play a growing role in sovereign markets, which can increase volatility when sentiment changes. If a large share of debt must be refinanced soon, even a temporary rise in yields can create serious pressure. But if maturities are extended across many years, the country gains time, flexibility, and protection from sudden market shifts. Reuters +1. The deeper truth revealed here is extraordinary. Debt sustainability is not about how big the mountain looks, but about how strong the economic engine beneath it really is. Growth, policy credibility, currency structure, maturity design, and investor trust all determine whether debt remains a useful financial tool or becomes a tightening constraint. That is why some countries can appear to carry enormous debt with relative calm, while others begin to feel strain much sooner under much smaller burdens. Now the story reaches one of the most thought-provoking questions in all of economics. Can a country ever truly become debt-free? And if it did, would that actually be a good thing? At first, the idea sounds ideal. No interest payments, no refinancing pressure, no rollover risk, and no concerns about rising yields. It feels like the perfect ending to the debt story. But once we look deeper into how modern financial systems work, the picture becomes far more complex. In reality, sovereign debt is not only a borrowing tool, it is also a core financial asset used by banks, retirement systems, reserve managers, insurers, and investment markets. OECD's 2026 debt outlook shows that government bond markets remain one of the primary foundations for stable financing and liquidity across the global financial system. This means that a completely debt-free nation would not simply be free from burden. It would also remove one of the safest and most widely used instruments that supports the entire economy. OECD +1. The first major reason countries rarely aim for zero debt is that government bonds perform essential economic functions beyond financing spending. Banks often hold them as highly trusted liquid assets. Pension systems use them to balance long-term obligations. Insurance institutions rely on them to match future liabilities with predictable returns. Financial markets use sovereign bonds as benchmark rates that help price everything from mortgages to corporate borrowing. Without these instruments, the broader system would lose a key anchor for stability, pricing, and risk management. In other words, debt is not just what a government owes. It is what the rest of the financial system depends on as a secure store of value. This is why many advanced economies continue to maintain active debt markets even when they have the fiscal capacity to reduce borrowing substantially. A second and even more important reason is economic flexibility. A nation with moderate, well-structured debt retains the ability to respond quickly to recessions, emergencies, infrastructure needs, education expansion, technology investment, and long-term productivity upgrades. If a country forced itself into a strict zero-debt position, it could unintentionally reduce its capacity to make high-value investments that strengthen future growth. Modern debt frameworks are built on the understanding that productive borrowing today can support stronger tax capacity, higher incomes, and more resilient institutions tomorrow. The real objective is not never borrow, but rather to ensure borrowing remains aligned with growth, affordability, and long-term stability. There is also a strategic market reason zero debt can be less desirable than people assume. Sovereign debt markets help create a yield curve, which acts as the pricing backbone for the broader economy. Short-term and long-term government bond rates influence lending costs across housing, business expansion, infrastructure finance, and institutional investment. OECD research in 2026 emphasizes that sovereign bond markets remain central to broader debt market resilience, especially as investor bases evolve and private financing needs rise. If a country removed this market entirely, it would lose a powerful policy and pricing mechanism that helps coordinate capital allocation across the economy. OECD +1. The deeper truth is that a country becoming permanently debt-free is neither common nor always optimal in modern finance. What matters far more is whether debt remains sustainable, credible, and productive. A nation with well-managed debt that supports growth may be in a stronger long-term position than a country with zero debt, but weak infrastructure, limited investment, and slower development. Debt, when structured wisely, can function less like a burden and more like a bridge between present needs and future prosperity. Now the story arrives at the ultimate thought experiment, the moment where the entire mystery of global debt reveals its deepest truth. What would happen if every country on Earth suddenly decided to pay off all sovereign debt at once? At first, this sounds like the perfect ending to the debt story. No bonds, no interest costs, no refinancing pressure, no rollover risk. It feels like the world would instantly become financially clean. But in reality, such a move would radically transform, and likely destabilize, the very foundations of modern finance. Sovereign debt is not only a liability for governments, it is one of the world's most important financial assets, deeply embedded in banks, retirement systems, insurance portfolios, reserve frameworks, and liquidity management. The IMF notes that sovereign debt plays a pivotal role in the world economy precisely because it supports continuity of public finance and broader market functioning. IMF +1. The first major shock would hit the global asset system. Every government bond that currently serves as a safe store of value for banks, pension funds, reserve managers, and insurers would disappear as it matured or was redeemed. On paper, the debt would be gone, but so would trillions of dollars worth of highly trusted assets that institutions rely on every day. Banks use sovereign bonds for liquidity buffers, insurers use them for long-term liability matching, and retirement systems depend on their stability for predictable returns. Remove all of those instruments at once, and the financial system would suddenly lose one of its strongest anchors. What looks like freedom from debt on the government side would simultaneously become a shortage of safe assets on the investor side. The second, and even more dramatic consequence would be liquidity disruption across global markets. Government bond markets do far more than fund public spending. They provide benchmark yields, collateral, and pricing signals used across almost every major financial activity. Mortgage rates, corporate borrowing, infrastructure financing, and even short-term money markets often use sovereign bonds as reference points. Without them, the global system would lose a core pricing framework. IMF research on sovereign bond liquidity highlights how deeply market functioning depends on these instruments not just as promises of repayment, but as actively traded assets that support liquidity across the broader financial architecture. IMF +1. A third consequence would be a paradoxical one. Countries might actually reduce their own economic flexibility by eliminating all debt. Sovereign borrowing exists partly so governments can spread the cost of long-term investments across time rather than forcing current taxpayers to bear the full burden instantly. If every country rushed to eliminate debt at once, many would need to sharply redirect public resources toward repayments instead of growth investments. That could mean less funding available for infrastructure modernization, education expansion, innovation systems, and resilience planning. The short-term victory of debt elimination could therefore weaken the very growth engines that make economies stronger in the future. Then comes the most fascinating layer of all. The money itself does not disappear. Ownership simply changes form. When governments repay debt, the bondholders receive cash or reserves in exchange for surrendering the bond asset. Those funds do not vanish. They move into other markets in search of safety and returns. Capital that once sat in sovereign bonds could rapidly flow into corporate debt, equities, real estate, commodities, or foreign assets. If this shift happened globally and simultaneously, the reallocation could create intense price distortions across multiple markets as trillions in capital searched for replacement assets all at once. Instead of reducing systemic risk, A universal debt payoff could merely transfer volatility into other parts of the financial world. The deepest truth of this chapter is extraordinary. Global sovereign debt is not just something countries owe. It is the structural scaffolding of modern finance. Trying to remove it everywhere at once would not simply erase liabilities. It would dismantle one of the most trusted layers of assets, benchmarks, and liquidity mechanisms that support global capital flows. In other words, the world's debt is not merely a burden carried by governments. It is also the safe foundation upon which much of the financial system stands.